Good morning and welcome everyone to this edition of the Real Wealth Solutions podcast. I am Darren Light along with my co-host as always, Greg Scully. Today we are joined by Logan Rankin of Rankin Investments. Logan hails, I believe you hail and invest in Wisconsin. We really appreciate you joining us this morning. If you would not mind, let's take a few moments to introduce yourself, what you've been up to and what you're up to currently.
Yeah, thanks guys for having me on. I appreciate it. Born and raised in Wisconsin. For me, a little bit of background. I spent about a decade working for a Fortune 50 company, did a ton in operations and leadership, led large P&L portfolios, enterprise-wide strategic operational change for them, and a lot of fun. And I realized my skill set pretty quickly was financials, operations, and leadership. And once I actually started to understand and change my mindset, which is something Greg was talking about a little bit earlier today, and understand like how to get my money working for me through real estate, I pretty much transitioned my skills into real estate. Back in 2013, bought a single family house as my first investment property, put all of our money to be able to acquire it and buy it, and worked out. Still remember, I won't forget it, made $3,200 that year. And that changed everything for me. I still remember like underwriting that deal and predicting that it was going to make about $3,100 or $33 or something like that. I was $100 off, but that changed so much. It wasn't the money, it was obviously the ability to be able to accurately predict and operate, or better said, control my investments. And in all the other investments like a 401k or a Roth or stock market, I didn't feel the same way. So I just doubled down from 2013 till now, somewhere around 120 million in real estate. Just think I crossed 1,300 or 1,400 units. I have about another 100 and 150 under contract right now.
Yeah, right on. What I love about that reference to the 3,200 you made, I remember kind of a similar thing, was that proof of concept. Getting from, oh my God, we're going to invest in real estate. What the hell are we doing? How does this work? And then, you get a direct deposit or a check. You're like, oh, okay, this does work. It is possible. And it's not wrapped up in a retirement account. I can actually just go spend it if I want to. So, coming back to the mindset, Fortune 50 company, that's not a bad position to be in. Theoretically, seems like maybe you can do some things financially just by sticking it through in the corporate world at that kind of level. Why switch?
Yeah, I think I didn't actually realize this quick enough, but as I grew, like one thing I always been taught is, you got to work really hard at anything you do and give it 100%. So as I was growing my real estate portfolio, I never sacrificed a minute I actually loved my Fortune 50 leadership position, and I kept getting promoted and making more money. In fact, my last position, I was making almost $500,000, and to give that up, and I gave that up before I was 30. So I came financially free at 30. And the reason I gave that up, to answer your question, and given up that trajectory, because as I started to educate myself in not just real estate and personal finance, it just became really, really clear to me that you either trade your time or you trade your money to get back time. And I remember doing an analysis just like I would on a property, and looking at how many hours a week am I spending to make the money that I'm making in my Fortune 50 job, which was about 70 hours a week. And, I had at my last 2 years, it was enterprise wide. So I was, spending 3 days a week heading to, all different places across the United States. So I calculated the 70 hours a week, and then I had a portfolio about 180, maybe 200 units at the time that I built up while working full time. So when I was working 70 hours at my job, I also was spending about 10 to 15 overseeing, because I had a third-party management company at this time. It was impossible to do that myself. I actually did we can talk about this later, but all three different kinds of ways you can manage your properties. I managed it myself up to 7 units. Then I had a third-party management company up to 180 to 200 units. And now I built my own management company, which I'm sure we'll talk about later. But long story short, 10 to 15 hours. And I was making as much, if not more, on my 180 to 200 units than I was at my W-2 job. And so it was just a really easy mathematical, like, well, how much is my time worth? And I wonder if I gave up to 70 hours and I spent a little bit more time on my real estate, how much more I could exponentially be able to grow that, or not. Because at this point, you know, you also start to realize it's not how much you make, it's how much you keep. And that was crazy too, is because I'm like, I looked at how much I'm paying in taxes on the money I was making in my W-2 job. And then I wasn't actually, I was making a ton of money in my real estate, but not paying any taxes. So it's just a really easy decision. And the only hard part was, honestly, like, you just, at my age at the time, you don't get those opportunities to lead. I mean, I was leading and overseeing a lot of people and a lot of financials for a really big company. And that was a lot of fun. It just wasn't as fun working and building my own business and being able to reap the rewards of the profit 100% versus giving it to somebody else.
Two things come to mind from myself. Number one, you say that at your age to be in that position is not common, and most people your age at that time would be riding that for at least another 10 years because they don't know any better, or they don't have a side gig, or they truly just don't know any better, or that's what they've been taught. But number two, when you did your analysis on paper, the amount of time you're spending on your W-2 versus in your real estate and what that actually looked like on paper, did you have a number in mind? Hey, I need to hit this number in real estate before I'm going to leave the job. Or what I tell people, because I get to do a little bit of coaching, is if you do have a number, when you're 75 or 80% there, go ahead and quit, because it will accelerate you getting there quicker as if you had not done it, if that makes sense.
Yeah, it totally makes sense. And Darren, that's a big mistake I think I've made. I think I should have left when I was 2 years earlier. I think not only did what you said, 75, 80% there, because then you, especially if you have enough confidence and education and mindset to explode it. Not only did I not do that, and not only did I not wait until I was 100%, I was 100% there by probably 28, because I operate at that time, I felt it necessary to operate our personal life like a business. So, understanding what, every dollar that's coming in and how to make it work hard. Also, every dollar that we're spending. And we had a pretty low operating expenditure, my wife and I and our family. And so not only did I not wait to 100%, but then also I wanted reserves. I wanted, my wife and I were living in a very conservative house. So I wanted to build her my dream house, and I was nervous about being able to do that without doing. So we did a lot of things before I actually pulled the trigger. We did build a dream house. We did build up the reserves. We did it in a very safe way. And I know we'll talk about debt later. And this is the thing I want people to understand too about me, is while I love debt and I didn't understand it 10 years ago, I'm very risk adverse. I try to mitigate my risk as much as possible. In fact, that's why I got into real estate in the first place. So that's what I think in my mind made me wait so long. And obviously it helps that you liked your job for the most part. But I think that's such a good topic to bring up, because I help people, I help a lot of people try to be financially free as well. And I tell people how I did it. And then I tell people one of the mistakes I made is I should have did it the way that you said, is when you're 70 to 80% there, pull the trigger, bet on yourself, and really just think about the risks, right? If you were that good at your job, it's not like you couldn't go back, God forbid something happens. But if you bet on yourself, I've never seen that go wrong. And I just think it's that leap of faith. So
I think about your coaching side now, and when you tell someone, hey man, I was financially free at 30, but I should have done it earlier, they're going to look like you have two heads. Yeah. So I'm hoping that maybe the majority of some of your clients are like 22, 23, 24. Look, we can get there before you're 26, and here's how you're going to do it. Maybe that's what you're encountering. I'm not sure.
Well, and also, when you're a little bit younger, maybe you don't have kids and a mortgage and some other debt. Your operating expenses might be low to begin with. So to jump earlier, or maybe just more possible financially. Me personally, I feel like I jumped a little bit early, I wasn't even at that 75 or 80%. There's a little bit of anxiety that goes along with that. So, kudos to you for getting everything lined up exactly the way you wanted it. In retrospect, you could have gone a little early, being on the other side of it. Like, man, I think we did go a little early. Yeah, there's some stress involved with that. So,
it's a good point. You're much more. I wish there's a they talk about simulators. I wish there's a simulator to put somebody through that stress, Greg, because I also feel like we're ignorant to a lot of things until we put ourselves in that situation. We just become more aware, which also can propel us faster. But there's an anxiety and stress that, I agree, that can come along with it too. And I certainly think doing it earlier might be a little bit easier, to your point, with the mortgage and the kids and everything else that happens. But just in general, I think as people change their mindset to, I personally believe you should spend 90% of your time focused on how to make your money work hard and just making more money in general. But so many people don't even focus 10% time on those expenses. Like, we were making a lot of money. I just shared how much, and we're living in $100,000 house, right? Like, my mortgage payment was like $600, and we had 2 kids and a dog. I'd consider a third kid. He's 100 pounds. So we
Eats a lot.
We made it work. Yeah. So, but I do think that's a good point. Depending on where you are in your journey, I think you got to assess, what that looks like. What your operating expenses is not just for a business or for properties; it's your personal life as well. And most people don't know what that is. Like, I know what my operating expenses is, and then on our personal life, and then I know, like, if you want to spend more after that, that's fine. But I think you got to find that threshold, because that'll also help you with financial freedom.
yeah, there's always something you can trim.
So,
And you have to examine it first, because I think maybe that's what you're getting to, Logan. Is, put it on a spreadsheet. Put all your expenses on a spreadsheet where you can examine them and be like, wow, are we really spending that much money on, streaming subscriptions or whatever it is? And then how much time do we actually spend watching TV? Or maybe we should just not spend that much time watching TV as well. It leads to, you might find other expenses that aren't necessarily financial in that examination as well.
Absolutely.
2013, your first single family. Did you get up to 7, or a variation thereof, duplex, whatever? You got to 7. You're managing by yourself.
Oh yeah, it took me, get this. So you guys kind of you shared a little bit how I've scaled quickly to where I am now, but it took me 3 years to buy 7 units. So I also want to share that today.
Wow. Okay.
I think a lot of people, that I mentor, and they see, 1,400 units, and by the way, I own those all myself. So no syndications, no, it's not assets under management. I own them all. I also own a property management company and a financial business as well too. But to be able to get there, people forget the first 3 years, I didn't know that much. And just like I said earlier, I always want to educate myself. I want to mitigate my risk. And I just didn't feel at the time, I had the education and I had the knowledge to be able to scale the way that I felt comfortable. So I really did a ton myself. And I think obviously, I think back, and, I shared, I should have left my job a little bit sooner. And yeah, I probably could have jumped into something a little bit bigger earlier, but I just didn't know what I didn't know. I didn't have any mentors. I didn't have any coaching. I wish I would have paid for some of that. I wish I would have known somebody in the real estate field. Everything for me came from books. So so it took me 3 years to buy those 7 units. I managed them all myself. I learned a ton. I will tell you, like, I still can remember to this day the first call I got, about the washer being broke and flooding, and like me going to my wife, what do we do? And she's like, just Google somebody that like in the area that can fix it. And after that, things got a little easier. I always feel like that's the difference between stocks and other kind of investments. Like, real estate is really easy to control. I mean, long as you build a network of people you trust, and people that can do the things that you can't do. I mean, I joke with people, I don't know how to fix the toilet, but I know how to run, 1,400 units. So it's a business where you can educate yourself and then find the right people to insert and help you just be able to grow. And I wouldn't take back that 0 to 7 managing myself, because you really start to understand that how much it costed you personally to go there and fix the washer, even if I could, right? Versus how little time it took to be able to call somebody and pay somebody for their services to be able to do that. And you start to understand what your time's worth and where to spend it.
I managed up to 8 on my own when I first started out. And it was a combination of, okay, what can I do? What do I have to call someone to get them to do? And, but that's truly, an education in more ways than one, with time, finances, and everything. So I don't regret that. All right. So so at that point, where you in your mind, you're like, okay, this is too transactional. What clicked in your mind? Like, I've got to get larger, faster, for more economies of scale, ease of everything. You were educating yourself. You knew that. What steps did you take to just go ahead and get that going?
Yeah. So one thing that I still do to this day. I read that the top 1% constantly update their net worth once a month, and 95% of everybody else in the world update their net worth whenever the bank asks, maybe once a year. And the reason for it is not only to be aware of where you are, but to make sure that you understand not how much you're making, personally, you're trading your time for money, but can you really assess how much your investments are growing? So to answer your question, Darren, I'm updating my net worth every month, and I'm watching my real estate substantially grow my net worth. The cash flow that's coming from them, the appreciation, the ability to be able to raise operating income and decrease operating expenses. Meanwhile, I'm watching my 401k slowly inch up. I'm watching, even though I'm getting promoted, even though I'm making more money every year, I'm watching my W-2 cash flows just slowly inch up. So after 7 units, that was one of the things that I really understood, that I need to make my money work hard. And I think that 3 years was definitely my proof of concept. There's something here. And when I understand something, I still felt like I didn't fully understand my 401k. I read a book a week. I mean, I was reading annual report after annual report trying to understand my stocks. I still couldn't. I'm no Warren Buffett. It was too complicated for me, and I felt like I had that lack of control. So I really doubled down, and all the money that we had sitting in reserves, all my investments, I actually stopped contributing any money to my 401k. That went to real estate. Then I stopped doing the match, especially after realizing that, Greg, you were talking about it, but it really upset me. I didn't understand this, that I couldn't access my 401k until I was 59 and a half without penalty. I actually didn't believe it when I read in a book. I had to Google it 3 different times. I asked a few people, I'm like, what do you mean? That's my money. What do you mean they're going to penalize me for taking my own money out? That can't be true. I started just realizing leaving money sit, how other people are using arbitrage to make money off of my money. And I said, there's just no way people are going to make money off of my money. I want to learn how to make my money work as hard as possible. And I want to reap the benefits because I'm the one who worked my ass off for it in the first place. So around that 3-year mark, that happened. That was my mindset shift. And obviously I just understood real estate a little bit more too by reading more and more books and figuring out that these smaller properties were great. I'm figuring out how to add different things to increase the operating income. I'm starting to figure out tweaks, right? To do different things with a unit. For example, you can harden it, right? We can go into that later, but you can redo a unit to not only increase income or the looks of it, but also decrease future operating expenses, which really help raise the NOI. And I'm like, man, if I had an apartment and I just do the same thing, with the duplex, I can only do that twice. But if I can do it in an apartment, maybe I grab an 8 unit, well, then I do it once, I figure out the strategy on the first unit, all the next 7 are easy. And then there's that economy of scale that come with it. And then I understood, Darren, obviously the benefits of utilizing appraisals based on the income approach, which was just a game changer for me versus, the comparable approach, right? Again, less control. Market's been pretty solid, obviously, since 2013. So that works in our favor, but I don't want to control what the duplex next to me is going for. So that's what mine goes for. I want to look at, like, someone's going to buy my property. They should base it on the profit that it's producing. And if I can increase the profit, I can increase the value. If I can increase that value, now I can reap the benefits of a refinance. And that's what really got me thinking about transitioning into larger apartments. The next year, year 4, I went from 7 total units. I actually bought 10. So I more than doubled what I had in 1 year. And then I think the year after that, I bought, 50 units. So it really started to scale after that. And mostly because of that mindset shift, and then understanding how to utilize, like, that refining your own property and reaping the benefits of your hard work.
So you own all these on your own. Was your strategy just refi and roll, go buy the next one, and you're able to do that enough? Or you had enough reserves where you could still throw some of your own capital in to continue to take them down?
Combination of both, right? I kept maxing out my money. I did, this is something I definitely don't do anymore, and maybe I don't recommend it, but I got such a taste for winning and controlling your asset, where the cash flow was, as I got bigger, I started to realize, like, you can, at 7 units, you have a vacancy, that sucks. Like, but at 57 units with a vacancy, like, you don't even feel that. Like, so it really starts to mitigate that risk. And so I started to answer your question, I started to realize that I want everything I have, like, I'm putting it into real estate. So I did have reserves in the beginning, and I was very, very, like, risk adverse, like a lot of reserves, too much. Took it all out, and I just started doubling into real estate. So that was one. I just used all the money I had. I already told you we lived a very frugal lifestyle, and I wanted to get financial freedom bad, right? My wife and I talked every single month about what we wanted most. We didn't want to upgrade our cards. We didn't want what other people were doing, going on fancy vacations at the time, or buying the $250,000 house, even though we could afford it. We wanted to do something different, so we put everything into it. And then obviously, once you get that ball rolling, because it doesn't happen right away, that refi out. It took 2 or 3 years of buying apartments before I really started figuring out how to reposition these properties, and then obviously how to take advantage of the refinance. So, and I would say the last 2 years, we've really nailed it. If there's anything I feel very confident on, other than pure operations, the company I built to operate my company in real estate, it's the repositioning of property effectively and efficiently in a very, very short amount of time. And I think the ability to be able to do that, obviously, when you can, like, I just refied a 56 unit apartment in 12 months to the day, and pulled out $2.2 million. So, if you think about at a 3.15 30-year amortization, no prepayment penalty. So, like, I mean, I think May or June was a 5.2% inflation. So 3.15% interest rate with a 5.2 inflation, like, just, I mean, what, and obviously the ability to reposition a property creates more cash flow. Well, if you create more cash flow, that's awesome. I'll take more money. But there's a not so awesome thing that happens. It's the profit that it's producing. Obviously, you have a higher likelihood of that being taxed. So not only does that refining give me more capital to be able to buy more properties, obviously, and continue to scale, but that mortgage interest, obviously, that can offset some of that profit too, because most people don't understand this. Like, while you want to make sure that your per door profit is high, right? You don't want to ever buy I'm in Wisconsin, so I better not be buying for appreciation. Okay. So it's all about cash flow here. But you also don't want too much cash flow. And this goes into your question, like, how do you scale? Like, I've always been very conscious about making my money work hard. And I would tell you, if you really want to maximize your amount of money, somewhere around 200 to 300 a door is the maximum amount of profit that you want. Anything more than that, I see these guys on social media bragging about $800 a door profit. That's dumb. Like, that is not making your money work hard for you. You're going to be paying a lot of taxes. Even if you cost sig, that's going to run out soon. With this kind of debt out there right now, and if you're confident in your ability to buy real estate and apartments or wherever you are in real estate, you should absolutely lower the profit per door, so you have less taxable income. You take that money, you buy another property, and you even that out. And that has helped me be able to scale a lot too, because I always try to stay within that threshold of my properties are very profitable, but I don't want to be too profitable and I don't want them to be under profitable.
Yeah,
By experience,
go ahead, Darren.
no, one last comment to that is, by experience, you've learned that's the sweet spot, and that makes total sense.
Yeah, well, what I was just thinking, maybe we could touch on some of these things. Some of what you said there I think is counterintuitive to some people. Actually lowering your cash flow just will not. You're going to be like, why would you do that?
Yeah.
And what's lost in that equation, you spoke to it, is you want to lower because you have a bunch of equity tied up in that property that is not really working for you, and that by doing the refi, you're getting that equity out tax-free, and you can redeploy it. So that equity is being converted to more cash flow somewhere else, first of all. And if you're worried about, I'm missing on some cash flow, you can use some of that refi for some runway if you need that cash flow for purposes, and deploy some of it. So it's like the kind of financial engineering or holistic way of looking at the possibilities of how your property can perform to you or for you. And then another thing counterintuitive when you talked about was the W-2 income versus what you were getting from real estate. And I think that can get lost on people is, yeah, you can have a really high W-2 income, but what you're netting after taxes may be something that is very achievable through real estate when your tax burden can very likely be zero or very close to it. So you're absolutely right. It's what you keep. You could be making $500K and keeping whatever, or you might be able to make $120K in real estate and be at the same level in terms of what's in your, what's actually trickling down to your bank account.
Yeah, Greg, 2 points there I want to expand on too, is like that it was crazy to me because I was one of these people that made this mistake, and it's still crazy to today that we teach almost no basic understanding of the biggest expense that people have in their lifetime, which is taxes.
Yeah,
and
no
people
doubt.
almost give it no thought at all. Like no thought at all. I try to explain, like, you don't even see it, right? Like you get your check at your W-2 job, then they take your taxes out, then you buy your groceries. And the biggest difference is in other things like business or like in real estate is you get your rent, then you buy your groceries, then you pay taxes. There's a big difference in what I just said there, right? In that analogy, like one versus the other. And it's just crazy how we don't pay attention to that. That's what you keep is it can be a substantial difference. And then I'm glad you said the counterintuitive piece on being too profitable, because it's a hard concept, I think, for some people to understand. A lot of people that I coach are higher net wealth individuals, and I constantly am up against, this is a really easy way to understand it. A lot of the people that I coach, these higher net wealth, they make a lot of money in their W-2 job, and they're obsessed with paying off their house. This is the best example I can give. They're obsessed.
If you didn't bring it up, I was going to, so please go ahead.
Yeah, I mean, this is the best analogy, and these are smart people. Just they don't understand. Like, so all they're focused on, if I pay off my house, I eliminate a $2,000 worth of mortgage, which have $2,000 more of cash flow coming in. That's all they can think about. But they never run the math that if they didn't pay off their house, right? Or if their house was fully financed, that if they actually invested that into something that makes like a conservative, like maybe 8 to 10%, if they and they're smart enough to be able to do that, that they would actually be, instead of saving $2,000, they actually be making $6,000 a month. So I try to I actually have to do the math, because after I talk about it, they actually still don't get it. So I actually do the math. I'm like, so what would you rather have? $6,000 more of income, net income coming in, or $2,000 less in expenses? I mean, obviously there's a $4,000 difference, but that's and then I'll get, well, if something bad happens, Logan, if I lose my job, I'm just going to feel so much better if my house is paid off. And I always this shocks me. I'm like, how are you going to pay for groceries if you lose your job? Your house is paid for. Are you going to eat your house? Are you going to start eating the bricks? How do you pay for the stuff? If you lose your job, you'd still rather have the $6,000 worth of money coming in. Obviously, if it's in a vehicle, unlike a 401k that pays you now. So that is a tough concept for people to understand with just debt in general, or how to maximize productivity of money. Because I think we're taught, all debt's bad debt, and it's all about compound interest, but nobody talks about velocity of money, or nobody teaches velocity of money. And right. I think that's a really interesting concept. And you can obviously apply it to what I was talking about in real estate, where your investment properties are too profitable. It's too much equity, to your point, Greg, sitting in there. But just on a very simple form, the amount of people that want to pay off their house, that's what drives me the craziest about Dave Ramsey. I understand. I don't want to go down that road today, but it's crazy. It's crazy you are missing out on probably one of the best opportunities of this decade, is if understanding debt and utilizing it to your advantage. When you have facts like 5% inflation and 3% interest rates, you are absolutely missing out on opportunities that people are going to look back 10 to 20 years from now and look at the 2020s. And I guarantee if you didn't utilize debt to your advantage, you are absolutely missing out on a huge wealth building opportunity. I believe that 100%.
Yeah, because find somebody in their 60s or 70s. I remember talking to my dad, just a conversation. It's like, hey, Dad, what was your interest rate for our first house you bought in Alaska? And he's like, oh, I don't know. I think it was 9 or 10, something like that. So, people are grousing about, 25 basis points movement in interest rates approaching 4. I mean, historically, these are still ridiculously low interest rates. Many people that have a lot more experience than I do, I've heard of, if they're like, hey, if anything under a 6 historically is just a very good opportunity for debt.
Yes. And you can make, you should be thinking about right now too. I think I shared this on a previous podcast, but you should be when you do, one thing I've been doing for almost a year and a half now is negotiating with my banks on making my debt assumable, especially if I'm locking in on 10, 15 year fixed. Because I think let's just say debt does creep back up to 6, which you're right, it's still really good. Can you imagine if you're going to sell your property? You're not going to just I'm always trying to think in the future. So if I'm going to sell my apartment community, now I'm not just selling it based on the NOI, right? Because obviously the NOI doesn't take in consideration debt service. I'm going to sell based on the NOI, and I'm going to sell my debt. If someone can assume a 3% rate, which I have on some of my longer term that I did last year, are you kidding me? That makes my property so much more valuable. And if there's 7 years left on that, 12 years left on that, I mean, that's anybody that's listening, you should just, some banks will do it, some banks won't do it, but I promise banks will do it if you find the right one. And if you can make that assumable and you want to sell, and rates do climb back up to 6%. Oh my God. Even if you can't optimize your property or raise the NOI, if you can only get a 6% 5 years from right now, and you got another 10 years left at a 3%, that absolutely is going to make your property be able to sell at a higher rate.
That's a fantastic tip.
Hey, it's Greg from Real Wealth Solutions. If you'd like to know more about our passive income opportunities, jump onto realwealth.solutions and hit that schedule a call button. We're always happy to talk about our multifamily and flip projects and to answer any questions you may have. Again, that's realwealth.solutions. We look forward to hearing from you. And now, back to the podcast.
So most of your debt or all of your debt is community-based.
Yeah. So that's a great. So I like this because we didn't really touch on financing to scaling, and obviously that besides repositioning and operating, I think obviously I started to build relationships with banks. Obviously, you usually work with presidents or co-founders now, and then you just understand. Like I didn't understand creative financing, so I bought $4 or $5 million properties with no money down. And I obviously, buy a lot of properties with 10 to 20% down, but obviously the ability to be able to creative finance, do seller financing, do all those type of things really comes into play with your experience and then your level of knowledge with, what you can do. I don't ever tell people to buy a property with no money down if you don't really understand. If it's not a value add, there's not equity to be gained, and obviously it's not cash flowing. But if you can find the right property and be able to utilize creative financing, that's huge. From a financing standpoint, I break my financing now down into 3 steps. First is local and community banks, just like you said, Darren. So 70% of my properties are value add. Off-market value add properties, meaning not stabilized. I'm able to implement my processes and operating procedures to create a lot of value. So all those properties need to go into the community banks because they trust me. They're personal, they're relationship driven, and most cases, not all, I can get into that property with very little of my own capital to buy it as long as it appraises out. And then I personally like to use my own capital to improve that property, not the banks. So that, for example, if they let me get into it with none of my own money, it's typical for me to spend $250,000 to $500,000 of my own money on that property. And all I'm doing is instead of paying that $500,000 as a down payment, I'm basically using it on capital expenditures to increase the value, increase the NOI, which hopefully, like my other example with the 56 unit apartment, let me pull out $2 million later on. It's better for the DSCR goes up, the banks like that, blah, blah, blah. Anyway, once I refi it, now I'm looking at mid-sized banks. So I love like credit unions, mid-size, right? Bigger type of banks that will allow me to, because usually community banks, at least in my region, 25-year amortizations, they don't really want to stretch that to 30. But a lot of credit unions will allow you to rather easily refi with them. At least in my credit unions, I can get no prepayment penalties, and they'll go to 30-year amortizations. And I like that for a couple of reasons. Most times I'm not done stabilizing this property. I want to quickly do it in the first 12 to 24 months. But 24 months after that, there's still a second refi I usually can get out of the property. So that's where I like that mid-sized credit union bank, right? The bank that has, instead of a 10 to 20 limit, legal lending limit, a 50 to 100 legal lending limit. And then, so that would be the second way, the mid-size that I usually go to. And then after I stabilize my property, then I like to look at the third and final way. So now there's not a lot of room to refi anymore. The property's very stabilized. And this is where I like to go longer term fixed financing. So that might be agency debt with like a Freddie Mac type thing where I can get 10, 15-year fixed on a 30-year AM. Obviously though, there's no chance of me refining. Like the prepayment penalty is severe, right? So you're pretty much locked in on that. And there's other programs with bigger banks, insurance companies and different ones like that, where you can get into where there's a longer term fixed. But the negative, while the positive is really nice because you really lock in these great rates. Also, this is the level for me that I get my loans into non-recourse, which the first 2 levels I don't. But that really is a level where I know the prepayment is too severe to do anything with it. So I'm going to lock it up. I'm not going to worry about it. And the only thing I might do in the future is exit that property, which, that the assumable piece comes into play.
Yep.
Have you gone full cycle on what you just described? Let's say this 3 steps or 2. Have you done a full cycle on something where you've gotten out?
And exited?
Yes.
Like sold it? Yeah, on 1, 2, probably on three properties.
Okay. Because of them being stable, what you could do, you couldn't do much more, and you got some crazy offer, or what did that look like?
Yeah. So in this case, I didn't want to be in the city anymore. So I went through all 3 steps. I optimized the property. I did as best as I could. For example, I'll just tell you, like, for one of the biggest mistakes I made is I all my properties I bought in good locations. They might look really, really bad, but they might be in a good location, except for one 28 unit apartment, 4 stories, not a great location. And I can't remember what year this was, year like maybe 4 or 5 into my investing career. And I kind of felt like it didn't matter anymore. I could just operate anything and just figure it out. Learned really quickly that just like everything, you might be able to control your building, but you cannot control what's around it.
Right. Right.
We did a really good job doing as much as we could. I even made a little bit of money on it, but for the amount of time that I put into reposition that property, if I factor just pure time, I actually probably lost money compared to my other properties. And so all 3 of them were in a city that I didn't want to be in anymore, to answer your question, Darren. So that's why I sold. One of my mentors said his biggest mistake was selling properties. So up to this point, I'm trying not to, but it's really hard not to, I'll tell you what, in this type of environment right now.
But the reasons you just listed for selling, I mean, they make sense to me. You're in an area you don't want to be in, plain and simple.
Yeah.
Well, how did you avoid paying taxes on that, Logan?
1031 them all.
Oh, okay.
There you go.
So yeah,
There you go.
The financial education and doesn't stop. Just because you sell something doesn't necessarily mean you have to pay taxes on it.
I sold recently a couple months ago a small 10 unit in the same city, and I rolled the $200,000 worth of gains into I recently took down a 146 unit apartment. So I rolled the profit of the 10 units in a city I didn't want to the city I did want, and was able to obviously not only buy in a better city, but also buy a much bigger apartment community.